Want to unlock the secrets of the stock market? It's like learning a new language, but instead of words, we use charts. They paint a picture of a stock's journey. Think of it like a treasure map. Stock charts are your guide to finding those hidden gems in the market. Now I know what you're thinking. Charts seem scary. All those lines and numbers can make your head spin. Trust me, I get it. But don't worry, I'm here to break it down for you. We're going to ditch the jargon and keep it simple. So, are you ready to become fluent in the language of the markets? Let's dive in. Think of stock charts as your financial GPS. They show you where a stock has been, and more importantly, they give you clues about where it might be going. Past performance doesn't guarantee future results, but it's like checking the weather forecast before you leave the house. Charts help you spot trends. Are investors loving this stock? Is it on a hot streak? Or is it heading south? Charts give you a heads up. Knowledge is power, right? With stock charts, you're in the driver's seat. You make informed decisions about your money. No more relying on rumors or your gut feeling. We're going to use data and logic. It's like having a secret weapon in your back pocket. Ready to take control of your financial future? Let's learn how to read these charts and unlock their power. Just like there are different types of movies, there are different types of stock charts. Each one tells a story in its own way. Some are simple, some are a bit more complex. But don't worry, we'll start with the basics. Think of it like choosing the right tool for the job. You wouldn't use a hammer to tighten a screw, right? The same goes for stock charts. Different charts highlight different aspects of a stock's performance. First up, we have the line chart. It's the most basic type of chart. Then we have bar charts and candlestick charts. Let's start with the MVP of stock charts, the line chart. It's simple, clean, and easy to understand. Imagine you're connecting the dots in a coloring book. That's basically what a line chart does. It shows you the closing price of a stock over a specific period. The closing price is the price the stock traded at when the market closed for the day. On the x-axis, you have the time period, like days, weeks, or months. On the y-axis, you have the price of the stock. The line connecting those closing prices tells the story of the stock's journey. Is the line going up? That's a good sign. The stock is trending upward. Is the line going down? That's a sign the stock might be losing value. Now let's add some more detail to our charts. Bar charts and candlestick charts are like the sequel to the line chart. They give you more information about price action. They show you not just the closing price, but also the opening price, the high and the low for each period. A bar chart looks like, well, a bunch of bars. Each bar represents one period, like a day or a week. The bottom of the bar is the low price for that period. The top of the bar is the high. Now, candlestick charts are where things get a little fancier. They use those same data points, open, high, low, close, but they display them in a more visually appealing way. Now, let's get back to those candlestick charts. They may look a little intimidating at first, but trust me, they're your friends. Think of each candlestick as a story about the battle between buyers, the bulls, and sellers, the bears. The body of the candlestick tells you who won the day. A green or white candlestick means the bulls were in charge. The stock closed higher than it opened. A red or black candlestick? That's the bears roaring. It means the stock closed lower than it opened. But there's more to the story than just the body. Those thin lines sticking out from the top and bottom of the candlestick, those are the wicks or shadows. They show you the highest and lowest prices the stock hit during that period, even if it didn't close at those extremes. Candlestick charts are like a secret code that, once cracked, can reveal valuable insights into market sentiment. Imagine you're at a concert. Which band is going to be more popular? The one with a packed stadium or the one playing to a half-empty room? The same principle applies to the stock market. Volume, or the number of shares traded, is like the crowd's roar. It tells you how much interest there is in a particular stock. High volume means lots of action. Investors are excited about the stock, whether they're buying or selling. Low volume? That's like crickets chirping. Not much is happening, and the stock might be less likely to make big moves. Now here's where it gets really interesting. Look at the volume alongside the price movements. If a stock is going up on high volume, that's a bullish sign. It means buyers are driving the price higher. But if a stock is going down on high volume, that's a bearish signal. Volume is like the heartbeat of the market. Let's be honest, stock charts can be a bit like roller coasters. Lots of ups and downs, twists and turns. That's where moving averages come in. They're like noise-canceling headphones for your charts. They smooth out those daily fluctuations and help you see the bigger trend. A moving average is simply the average price of a stock over a specific period, like 50 days, 100 days, or 200 days. By plotting these averages on your chart, you create lines that cut through the clutter and reveal the underlying direction of the trend. The most commonly used moving averages are the 50-day and the 200-day moving averages. When the 50-day crosses above the 200-day, it's often seen as a bullish signal called a golden cross. Conversely, when the 50-day crosses below the 200-day, it can be a bearish sign, known as a death cross. So far, we've covered the basics of stock charts: line charts, bar charts, candlestick charts, volume, and moving averages. But the world of technical analysis goes much deeper than that. There's a whole universe of technical indicators out there, each designed to measure different aspects of price action and market sentiment. Think of technical indicators as your stock market toolkit. You've got your hammer, moving averages, your screwdriver, volume, and now you're adding wrenches, pliers, and maybe even a power drill. These indicators can help you identify overbought and oversold conditions, measure momentum, and even predict potential reversals. Some popular technical indicators include the Relative Strength Index, RSI, MACD, Moving Average Convergence Divergence, and Bollinger Bands. Don't worry about memorizing all of them right now. The key is to start exploring and find the indicators that resonate with you and your trading style. Remember, technical indicators are just tools. They don't predict the future. All right, let's talk strategy. You're ready to dive into the world of stock charts, but where do you even begin? It's like stepping into a grocery store with a million aisles. Don't get lost in the weeds. Start with the big picture, like deciding whether you want to buy cereal or ice cream. Begin with a longer time frame on your charts. Look at the stock's performance over the past year, even 5 years. This gives you context. Is the stock trending up, down, or just bouncing around like a rubber ball? This is your starting point. Then, zoom in gradually. Look at the past 6 months, 3 months, and finally, the daily chart. This helps you see how the stock is behaving in the short term relative to its long-term trend. Start broad, then narrow your focus. It's like finding the perfect outfit. You don't just grab the first shirt and pants you see. Now, I know it's tempting to jump in and buy a stock the moment you see a dip in the chart. It feels like you're getting a bargain, right? But hold your horses, cowboy. Not all dips are created equal. Remember those candlestick patterns we talked about? Pay attention to them. A dip with high volume and a long lower wick. That could be a sign of panic selling, and it might be a good time to buy. But a dip with low volume and no real support level, that could be the beginning of a much larger downtrend. You don't want to catch a falling knife. Remember, patience is a virtue, especially in investing. Wait for confirmation from your charts and indicators before you hit that buy button. Here's the deal. Reading stock charts takes practice. It's like learning a new dance move. You're not going to nail it on the first try. You might step on some toes, stumble a bit, but that's okay. The more you practice, the better you'll become at recognizing patterns, interpreting indicators, and making sense of all those lines and squiggles. Luckily, we live in a digital age with more resources than you can shake a stick at. There are tons of free charting websites and apps out there that let you practice reading charts with real-time data. Think of it like a flight simulator for your investment journey. Don't be afraid to experiment with different chart types, time frames, and indicators. Congratulations, my friend! You've taken your first steps towards mastering the art of stock chart reading. You've learned about different chart types, key indicators, and practical tips for getting started. But remember, knowledge without action is like a car without an engine. It won't get you very far. Now it's time to put what you've learned into practice. Start incorporating stock charts into your investment research. Use them to supplement your fundamental analysis, identify potential trading opportunities, and manage your risk. With a little knowledge, a dash of patience, and a whole lot of practice, you can use stock charts to gain an edge. Let's bring those charts to life, shall we? Think of Apple. Everybody loves Apple, right? But back in the late 90s, they were almost down for the count. Then, boom, the iPod hit the market and the rest is history. You can see this turnaround in their stock chart. Before the iPod, Apple's stock was stuck in a rut. Low volume, barely moving. But when that little white device took the world by storm, the chart exploded. High volume, soaring prices, it was a bull's dream come true. This is a classic example of how charts can reveal a company's story. The launch of a new product, a change in leadership, even a shift in consumer sentiment. It all shows up on the charts. That's the power of chart reading. It helps you identify potential winners before the rest of the market catches on. Now, let's fast forward to the electric car revolution. Tesla, the brainchild of Elon Musk, has been making waves in the auto industry, and their stock chart tells a fascinating tale. Remember those moving averages we talked about? Tesla's chart is a textbook example of how they can help you identify trends. Look at their 50-day and 200-day moving averages. When the 50-day crossed above the 200-day, it signaled a bullish trend. And boy, did that trend take off? But it hasn't been all smooth sailing for Tesla. Their stock is known for its volatility, with sharp ups and downs that can make even the most seasoned investors' heads spin. This is where chart reading becomes crucial. By understanding candlestick patterns, volume, and other technical indicators, savvy investors can navigate Tesla's roller coaster ride and potentially profit from its wild swings. It's not for the faint of heart, but it shows how charts can help you manage risk and make informed decisions in a fast-moving market. All right, let's address the elephant in the room. What about the times when things don't go as planned? The stock you thought was a winner tanks faster than your retirement dreams after a market crash. Don't beat yourself up. It happens to the best of us. Remember those candlestick patterns that signal a potential reversal? Ignoring them can be costly. Imagine seeing a bearish engulfing pattern on your favorite stock's chart, but you're too emotionally attached to sell. You convince yourself it's just a blip. But then the stock plummets, taking your profits with it. Ouch! This is why we learn from our mistakes. Each trading loss is an opportunity for growth. Analyze what went wrong. Did you ignore a key indicator? Did you let your emotions cloud your judgment? By studying your past trades, you'll become a smarter, more disciplined investor. Remember, even the best batters strike out sometimes. It's not about being right all the time. It's about managing your risk and learning from your mistakes so you can hit a home run when it matters most. So there you have it. We've journeyed through the exciting world of stock charts. Remember that line chart, your trusty sidekick? It's like the first bicycle you rode. Now you're doing wheelies with candlestick charts and volume indicators. You're practically a pro. We've seen how charts can reveal a company's story, like Apple's triumphant comeback with the iPod, and how understanding moving averages can help you ride the waves of a high-growth stock like Tesla. But most importantly, you've learned that knowledge is power. By using stock charts, you're not just throwing darts in the dark. You're making informed decisions, managing your risk, and taking control of your financial future. It's like having a roadmap to success, but instead of leading to buried treasure, it leads to financial freedom. Now, what are you waiting for? The stock market isn't going to wait for you to feel ready. It's like a race car, always moving, always changing. But you're in the driver's seat now, and you've got the keys to success. Start exploring. Open up a free charting website. Pull up the stock of your favorite company and see what you can find. Look for trends, identify patterns, and experiment with different indicators. The more you practice, the more confident you'll become. Remember, investing is a marathon, not a sprint. There will be bumps in the road, detours, maybe even a few fender benders along the way. But with stock charts as your guide, you'll be well equipped to navigate the twists and turns of the market and cross the finish line with a portfolio that makes you proud. So buckle up, hit the gas, and let's go.